All right, we're here with Yuko, CEO of Hito LLC. And in this episode, we're going to go through California tax credits, tax exemptions, and tax exclusions like partial sales and use tax exemption. And then I don't even know how to say this one, California EATFA use tax exclusion. Did I get that?
Yep.
Love it. And then employment tax incentives like the new employment credit, employment training panel. And then we're going to do something we haven't done before, which is to end with some rapid fire questions and some do's and don'ts coming straight from Yuko. So we're excited to have you join us.
Yes, I am ready.
Let's dive in. So California incentives, this is our quick guide. We're going to start with the California R&D credits.
Yeah, so objective is California government to incentivize companies who are doing innovation in California. And this is piggybacking from federal Section 41 R&D tax credits. So it's very similar, any companies who are innovating and fits into full per test we talked about
Right.
before too. If you can qualify your wages, contractor fee, and supplies consumed during the R&D will qualify expense for R&D tax credits.
Right.
And similar to Section 41, California does not refund any unused tax credits, but you can carry forward indefinitely.
Okay.
Yeah. So federal is 20 years and California is indefinitely. So that's the huge difference.
And a tax credit, and we're going to get to this a little bit later, this is coming off of your taxes as opposed to cash back.
Correct.
Okay.
And a lot of people ask us, tax credit is dollar to dollar reduction of your taxes.
Right.
Okay.
That's amazing. Okay. Let's talk about the California Competes tax credit.
Okay. So California Competes tax credit, objective is to incentivize California companies or company expanding into California. So they are using tax dollar. Everybody's tax dollar to how to retain the companies or attract the companies. Mm-hmm. So a lot of time they are looking for, are they creating new job? What is their 5-year commitment on the job creation and also capital investment? A lot of time California also look for is competitiveness, right? Mm. If they have to be in California, restaurant, right, or barbershop, they are not gonna incentivize those companies. But
right.
Let's say manufacturing company, they could be here in California or they could expand in Tennessee, for example. Right. They are looking for hey, are we gonna lose those jobs if we don't give them award? So those are the type of company and expansion they are always looking to fuel their investment into.
And those are negotiated beforehand.
Correct.
You don't apply for them after. Mm-mm. So as we're going state by state and we talk about Tennessee's or whoever else's tax credit system, essentially what you're doing is just pre-having the conversation with the state of California saying, hey, we could be moving somewhere else, keep us here, or incentivize to move manufacturing, move these jobs here to get that tax credit.
And the California is a little bit odd. So
yeah.
You have 3 application round within the fiscal year.
Okay.
So next one is going to be in January 2026. And they are open for about 2 to 3 weeks. And if you don't apply for that time frame, you cannot negotiate. Other states, for example, you could negotiate if you decided to expand or you have future project anytime with the governor's office.
This is a very structured program. There's a window to apply. It's not just open-ended, do it when you want to.
Right.
Okay, very interesting. Okay, anything else on the California Competes tax credit?
So just a couple of things to know on the California Competes tax credit is the credit will be objective or subjective. You need to think about how much you need to have that awarded to
Sure.
Stay here or come to California.
Got it.
And then those are non-refundable tax credits. So if you're not taxable in the States, you cannot use it, right? And then unlike R&D tax credit, the carry forward is only 6 years. So
not
you
20.
have to, not 20 or not indefinitely, right?
Got
so if you're not thinking about you're not going to be taxable in next 6-7 years, this won't apply to you.
Yeah. So if you're a startup that's not taxable yet, most other businesses would be potentially.
Yeah.
Yeah, that makes sense. All right, let's jump to the employee training panel.
Oh, this one is fun.
Tell me more.
Yeah, so objective is to reimburse employers who are upskilling their employees skill set, right?
Sure.
And if you think about it, everybody pays into this ETP fund. So
Right.
partial part of our payroll tax dollars goes to ETP fund, and company can use that to fuel their training program. And a lot of time, we see is hey, these are big companies, project, but a smaller company can definitely take advantage of this, right? And what California is looking is can our employer investing in employees training, right? So we are not talking about skill accounting skills or anything like that. It could be hey, manufacturing plant, they need to teach them how to become better toolist, or
Sure.
you could be admin people how to become manager and how to problem solve. Any kind of training would qualify, and we will go through that exercise with a ETP agent before we go into negotiation with panel. But investment, the reimbursement dollar is anywhere from $18 to $25 an hour employees spend each hour in a training.
Wow, that's significant.
So if you have 100 employee or 75 employee and doing 40 hours of training every single year, it might worth looking into it. It's a lot of paperwork,
see.
but if you create the structure, California is really good at reimbursing those training hours they have spent. And so this is not tax credit, and this is a cash reimbursement too.
Oh, okay. So you get cash. So if you're in startup mode, this isn't something you have to wait for, something to count against your taxes that you're paying.
Mm-hmm.
This is actually dollars they're giving you in form of a check. Very interesting. How do you, obviously you're saying it's a lot of work and paperwork to apply. You have to apply and get your training program approved. What does this typically look like?
Yeah. So they're going to be application phase where we apply for initial information. After that, there's an ETP agent assigned to your case, and they're there to help us navigate application process before it goes to panel discussion. Panel discussion is where California ETP panel said, okay, company, it's approved, and then next day you can start the training.
I see.
The documentation portion I'm talking about is once training starts, we have to actually keep track of who was trained, how many hours, and who was leading the classes.
I see. Okay. Well, that's reasonable. It makes sense. If they're paying for it, they want to know that it's happening. Okay. That's amazing. How big of a company typically, I guess, how small of a company qualifies for this?
So any company would qualify, but our company typically takes company more than 50 or larger, 50 employees or larger.
Got it.
But
Okay.
there are company out there, so if you're 10 people company and interested in this type of training, contact us and
Love it.
we'll
Okay.
happy to connect you.
Let's, are we good on that one? Should
Yeah.
we move on to the next one? Okay. Let's talk about partial sales and use tax exemptions. This is manufacturing and R&D specific, is that right?
Yes.
Okay.
So a lot of people know about this, but some people don't know. So I just wanted to talk about it.
I don't. Tell me more.
So if you are purchasing equipment or machinery, there is a partial exemption of sales tax of
Okay.
those equipment if you're primarily using for manufacturing or equipment for R&D purposes.
I see.
Yeah.
So but how big is this credit? How much does it apply? What happens there?
So it's small. So typically, it's only gonna partial exemption only gonna apply for state sales tax portion,
I see.
and it's about less than 1%.
Oh, so,
But
okay.
if you have that exemption paperwork, you just need to give it to your vendor, and they will take care of that.
Okay. And it's only, it doesn't count in regional or county sales tax. It's
Correct.
just state sales
Yeah.
tax. Okay, that makes sense. Let's talk about the new employment credit.
Oh, this was the objective was incentivize and creating job in the designated area. So I don't like people remember this, but like, California had what's called like enterprise zone credit back in the day, which was very, very lucrative for like, companies. And it was too lucrative and like it was very bad for like,
getting too much money.
state budget. So new employment credit has replaced that. But if you're designated in like, distressed area, if you're creating like new jobs, like, you could qualify for like tax credits. But there's a like application phase. So like within the 30 days of like, employment hire day, you have to get like, certification from EDD saying that, hey, these are the qualified employee you can take credit for.
Got it.
Yeah.
So hiring new employees, you're then allowed to get the credits for each of those new employees and get a tax credit from the EDD on your payroll taxes.
Mm-hmm. And this is tax credit, so it's non-refundable, and I believe like carry forward is like up to 5 years.
5 years.
Yeah.
There's a lot of variances in this. 26 years, 5 years. You really have to be thinking through what the tax planning looks like. And this really goes into strategic tax planning. That's not just your normal annual cycle, right? You're thinking through this in a lot more disciplined, strategic way than most organizations or most business executives are thinking through their tax planning strategy.
Yeah, a lot of them, like I see, like, those points is like, when they're not taxable, companies are not taxable, they're not taking R&D tax credit, although like they could qualify thinking that they cannot use it.
Yeah, what's the point? We're not outlaying cash right now. And then they go, wait a minute.
But like, R&D credit could be like, perpetually like carried forward where they're taking CCC, California Competes tax credit, where those like carry forward is like only 6 years. And all those like negotiation, like, is out of the door because although you get like, tax credit, you cannot use it. So you have to really look at like each program and like, think about holistically, like, what makes sense to like, kind of bundle together for tax credit, tax incentives.
Right. And if you're moving into an area or could negotiate some of these tax credits, just because you're not paying anything today could be a huge miss 3-4 years down the road where you could take advantage of all of that. All right. Anything else on new employment credits?
Nope.
Okay, this is the one I still don't know how to say. California EATFA, sales and use tax exclusion. Yeah. Let's talk about that one.
This is a new one, but I think this is the sales and use tax exemption of like, purchase of like alternative energy sources.
Okay, that makes sense.
Yeah. And then advanced transportation, recycling, advanced manufacturing product too. So if you are purchasing those like, 100% exclusion from the state and local, I believe, local sales and use tax.
Okay, so similar to the manufacturing piece, it's just applying to the specific category of alt energy, advanced transportation, recycling, and advanced manufacturing.
Yeah, and I know
Can you stack those? Can you stack advanced manufacturing and manufacturing and R&D equipment?
I think for advanced like manufacturing, like if you're taking the I think you want to take the California EATFA exemption because that's 100% exemption on both state and local level, where manufacturing exemption is only the state level.
So you're not stacking it, but it's better. Take this category and it's going to work out better for you.
Right.
What counts as advanced manufacturing?
That I don't know.
You got to fill out the form and find out. I love that. I'm assuming it's the same thing. You're negotiating an approved project. Mm-hmm. Is that how that works?
Yeah, typically.
Okay.
Yeah. And then for the California EFTFA exemption, like, a lot of companies are like, developing solar farm and biomass farm, like, because of an ITC phasing out end of this year. So if you guys are working on, like, anybody's working on those projects, you probably want to look at this if you're in California.
Got it. So it's a very specific credit. I mean, we've seen other states do things, chip manufacturing credits. California's really looking at the advanced transportation, the recycling, the more sort of earth-friendly things that California is known for. So if you're in this space, this is pretty big. Does this have a window too to apply, or is this open-ended?
I think it's like extended to January 1st, 2026
so
right
the
now.
Window is closing is what you're saying. Okay.
But I believe like they're probably going to like announce like extension, like, after that.
Okay.
Yeah.
And so you're negotiating this, you have approved vendors that you have to get the tax credits from, and it happens when you purchase. So it's before you purchase, not after.
Right.
Got it. Okay, I think we hit them all. It's interesting. We always have these sorts of conversations, especially around R&D. We talk about California, and then it's always this sort of matches the federal credits. I think that's true a lot in the R&D space. Let's do some of our do and don'ts. So let's just start with our do and don't number one. What do you got for us?
I will say, look at credit holistically and smart, stacking those credits or incentive in a smart way. Not just look at R&D tax credit, but if you're profitable, look at ETP, look at California EA, TFA, different things to making sure you maximize those credit. Because a lot of time, I hear is R&D tax credit is too small to think about, or this credit is too small. But if you start combining and stacking those tax credit, it might be meaningful for companies.
That's great. So just don't assume that the one thing is all you qualify. There's probably a lot of things you can stack. I love that. All right, what's number two?
I will say planning and time kills. So for example, NAC, new employee credits, those type of stuff, if you miss the windows, you cannot take credits, right? If CCTC, California Competes Tax Credit, if you miss the window, you cannot negotiate. So
time kills credits. That's a big one. Okay, and I think you have one more. What's the last one for us?
I'll say cash versus credits, whenever we talk about tax credit, a lot of people are just looking at income tax credits, right? So look at state credits where they can give you exemptions or abatement of state and sales and use tax, or abatement of property tax to cash reimbursement or cash grants, and also tax financing too in a lower interest rate.
That's great. Thank you. All right, I'm going to give you some rapid fire questions, and we'll see what this turns into. If you had to explain California's R&D credit in one sentence, how would you describe it?
R&D tax credit is the objective is to incentivize any company doing innovation in California.
Great. Let's go to startup world for a little bit. California is known for this. What's the one mistake startups make when applying for incentives?
Oh, that's a good question. I'll say biggest mistakes they are making is they assume they don't qualify for credits.
Yeah, that makes sense. We're in startup mode. We're not paying taxes. What's the point?
Yeah.
And then there's some big credits that could be coming their way, even in the form of California giving them a check and giving you cash.
And going back to federal, right? Federal R&D tax credit, first 5 years of inception of the company, they could use that for payroll taxes too.
Oh, wow. All right, last one. What's one tip every founder should act on before year end?
Stop thinking about tax credit or tax planning as annual thing or separate year thing. Think about long-term plan and really talking through with your stakeholder, your CEO, CFO, your CPAs, and tax credit people and financial advisor too. Where are you going as a company, and how you plan out tax credit, tax incentive. If you guys are thinking about expanding next couple of years, this might be the year you have to start negotiating tax credits, right? If you're hiring 20 people and opening back office in some other states, you want to start the negotiation now instead of waiting to the day you're going to sign the lease. That will be too late.
So instead of doing annual tax planning, look at a 5-year tax plan or a 10-year tax plan that incorporates all of these credits.
And that goes to not just business, but personal tax planning too. As an owner, if you have tax liability coming up, what can you do above and beyond tax credits, tax incentive, right? What can you do to minimize your taxes?
Love it. Thank you. This is amazing. It's been a fun episode going through California, and we'll catch everyone on the next one.
Awesome. Thank you.